So that's stuff we will get to in just a bit. Steve Brice is Chief Investment Officer at Standard Chartered Wealth Management. He's joining us right now to take some questions. Steve, great to have you with us here. So which way is the wind blowing this morning? Very near term. Risk on or continued risk on? Or do you think, gains will be pared back? Your sense?
So, obviously in the India market looks pretty optimistic this morning, but I think if we're looking at the global markets, still people are a little bit on the defensive, obviously following the Fed FOMC meeting last week, where they indicated that rates are probably going to go higher than the market was anticipating, even if it's at a slower pace, which it was being anticipated, obviously following the Wall Street Journal article. So that's really a bit of a challenge. The employment report on Friday clearly had some things for both sides of the argument, I guess, but strong job creation, upward revision to the previous month. Still accelerating earnings, wage growth is still going to, I think, keep the Fed very, very focused on fighting inflation. And that's putting upward pressure on bond yields and obviously therefore putting downward pressure on stocks for the time being.
We've had a fairly strong run here in India, Steve. Do you think that can continue? And what could be the leaders in the next leg of the rally?
Yeah, so obviously the Indian market has done very well compared to the rest of the world. We are continuing to be overweight the local market there. I think the industrials still look pretty positive. A lot of people talking obviously about the China plus one strategy, so the geopolitical environment, if anything, might favor countries such as India, Mexico, and Southeast Asian countries as well, in terms of people saying, okay, we're going to need to redirect our manufacturing capabilities, or at least have a plus one strategy. So that's obviously quite positive. FII flows from an India market perspective obviously have been very weak. So there's been a domestically driven one. If we did see that dollar peak out, and I think it's too early to say that it has done, but if we did see that peak out, then obviously that would be a big positive for the Indian market as well.
Hi, Steve. The U.S. markets have had a good run in the last month, 40 days or so. How much of the good news is in the price? Waiting by for the midterm election, so that's going to be an important trigger. But how much of the good news is in the price? And if we don't get a favorable outcome, does the downside open up?
So we see this as a bear market rally still, right? So just from a macro perspective, we actually don't think that the outcome of the election is going to be that important, to be honest. It's almost a done deal that you'll get a split government. That means they're going to be very difficult to do anything. If anything, that's probably a negative in terms of, we get the debt ceiling coming up again in 2023. And if we did move into a recession as we expect, then you might get a slower than normal policy response. You'll still get it coming through, of course, because nobody wants to be responsible for a deepening recession. But that might be a bit slower. So, in balance, we think this is, obviously markets have done pretty well for a few weeks, but we wouldn't be buying here. We'd be saying, look, we think we can see some consolidation and maybe making new lows before we form the long-term base some point in 2023.
So, Steve, you believe we'll revisit those June lows on the Dow?
So we think we might go back and maybe even go lower than that, right? So we feel that the markets are not pricing in the earnings downside that we are. Obviously people are looking for around 7% earnings growth next year. We think it could actually be negative. On the positive side, of course, as rates adjust lower, which when a recession hits, that's likely to happen. Then that could help them from a valuations perspective. But I think there's still a transition phase of shifting from 7% to much lower earnings growth, which could lead that leg to breach the lows we've seen so far this year.
Steve, a lot of people here in India who've been to the US recently, and we've spoken with a bunch of them, marketing trips, etc., trying to raise money. They've come back and told us that the sentiment is, in a way, anything but China, right? And India, in that sense, is a big potential beneficiary. So on a relative basis, we've spoken about this optimism, this relative optimism. But for viewers who are watching, who are local investors, what does this mean in an absolute sense, Steve? Yeah.
Yeah, I think you're right. I mean, sentiment towards China is clearly very negative. The question is it peak pessimism as far as China is concerned? You saw just some, speculation last week leading to a very sharp rally in Chinese assets. So if we did see an easing of the COVID restrictions in the course of the next 6 months, I think before winter, sorry, it's probably going to be a bit challenging, but maybe after winter, then that could lead to a very big leg up. But from an Indian market perspective, yes, I think people understand. I mean, from my perspective, I like the demographic story as well, much better than most of the world in India. And if you do see the manufacturing gap being filled in a significant way, then the Indian market could do incredibly well over the next few years. And with foreign investment coming in as well, that would be a big positive.
Oh, absolutely. And the foreign investment has picked up thick and fast, right, here in India. I mean, in just 6 trading sessions, the FIs, actually less than 6 trading sessions, the FIs have bought over 6,000 crores in the Indian markets. This speaks a lot about the trajectory here. But we leave it at that, Steve. Thanks a lot for joining in and giving us your quick thought. That's Standard Chartered with their view on the markets. But let's slip into a quick break.